Welcome back to Brainy Bytes. Ready to absorb the knowledge that fuels top performers and makes you the sharpest mind in the room? They say the average CEO reads a book a week. Imagine having that power distilled for you. Stick with us for today's life-changing insights and hit subscribe and the bell so you never miss the wisdom to reach your peak potential. The Simple Path to Wealth. J.L. Collins. Full summary. Does investing feel overwhelmingly complicated? Are you tired of confusing advice from Wall Street and financial gurus pushing complex products? What if building serious wealth and achieving financial independence was actually simple? J.L. Collins, in his widely acclaimed book, The Simple Path to Wealth, cuts through the noise and lays out a clear, straightforward, and proven strategy originally written as advice for his own daughter. Introduction. Today we're walking the simple path to wealth. J.L. Collins isn't a Wall Street insider trying to sell you something. He's a financial writer and enthusiast who figured out how to make wealth building accessible and understandable. The core premise of the book is powerful in its simplicity. Achieving financial independence, having enough money so work becomes optional, is simpler than the financial industry wants you to believe. It hinges on a few key principles: spending less than you earn, avoiding debt, investing the surplus consistently in low-cost, broad-market index funds, and most importantly, staying the course over the long term. Forget complexity. Embrace simplicity and discipline. Core philosophy: why simple works best. Before diving into the how, let's understand the why behind Collins' approach. Number one, the goal is financial independence, or FU money. The ultimate aim isn't just getting rich, it's achieving financial independence, or FI. The point where your invested assets generate enough income to cover your living expenses indefinitely. Along the way, you build FU money. That's having enough savings and investments to give you the power to walk away from situations that don't serve you, like a bad job or toxic environment, long before you reach full FI. It's about gaining control over your life. Number two, complexity is the enemy. The financial industry often benefits from making investing seem complex, requiring their expensive guidance or products. Collins argues vehemently against this. Simple is better. Avoid high fees. Actively manage funds that rarely beat the market timing attempts, and financial advisors who aren't sworn fiduciaries acting solely in your best interest. Complexity usually benefits the seller, not the investor. Number three, the stock market is your friend long term. Despite its scary ups and downs, the stock market as a whole has historically been the most powerful wealth-building engine available. The key is to own a broad slice of it through low-cost index funds and hold on for the long term, letting economic growth work for you. Number four, avoid debt
Brainy Bytes.
like the plague. Especially high-interest consumer debt like credit cards. Debt is the anti-wealth machine. It makes you work for others instead of having your money work for you. Get out of debt as aggressively as possible, particularly before focusing heavily on investing outside of perhaps an employer match. A mortgage on a reasonable home is generally considered acceptable debt within this framework. Number five, embrace bear markets when accumulating. Market crashes are terrifying, but they are a normal part of the economic cycle. If you are in the wealth accumulation phase, still saving and investing regularly, market downturns are actually beneficial. They allow you to buy more shares of your index funds at lower prices, like a sale. The absolute worst thing to do is panic sell during a downturn. You must have the discipline to stay the course. The Simple Path Strategy, How to Do It. So, what's the actual strategy Collins recommends? It's beautifully simple. Number 1, save aggressively. Your savings rate, the percentage of your income you save and invest, is the most powerful lever you control in the wealth accumulation phase. While Collins advocates aiming extremely high, like 50% or more if possible, the key is to consistently spend less than you earn and invest the difference. The higher your savings rate, the faster you reach FI. Number 2, invest primarily in a total stock market index fund. This is the heart of the strategy. Collins specifically champions Vanguard's Total Stock Market Index Fund Admiral Shares, ticker symbol VTSAX, or its equivalent exchange-traded fund version, VTI. Why? Because it gives you ownership in virtually every publicly traded company in the US, providing maximum diversification at an incredibly low cost, low expense ratio. He argues this single fund is likely all most US investors need for the stock portion of their portfolio during the wealth accumulation phase. While he acknowledges some might add an international stock index fund like VTIAX or VXUS for global diversification, he emphasizes keeping it simple. Number 3, automate and hold. Ignore the noise. Set up automatic contributions from your bank account to your investment account every payday or month. Reinvest all dividends automatically. Then do nothing. Ignore the market news, the predictions, the fear, the hype. Just keep buying consistently, month after month, year after year, decade after decade. This buy and hold or set it and forget it approach prevents emotional decision-making, which is the enemy of long-term investing success. Number 4, the withdrawal phase strategy, the basics. Once you reach financial independence or retirement, the strategy shifts slightly from accumulation to preservation and withdrawal. Collins discusses the widely known 4% rule as a reasonable guideline. The idea that you can potentially withdraw about 4% of your portfolio's value each year with a high probability of your money lasting. During this phase, he suggests potentially adding a bond index fund like Vanguard's Total Bond Market Index Fund, VBTIX or BND, to your portfolio to reduce volatility. Adjusting your stock bond allocation based on your risk tolerance and needs. The book provides more detail on navigating this phase. Real-world application, walking your simple path. How do you put J.L. Collins' simple path into action? Number 1, calculate your FI number. Figure out roughly how much money you need invested to be financially independent. A common guideline is 25 times your annual expenses. Knowing your target helps motivate saving. Number 2, eliminate high-interest debt. Make getting rid of credit card debt and other high-interest loans your absolute top priority. Number 3, maximize your savings rate. Find ways to spend less than you earn and increase the gap. Automate these savings.
Brainy Bytes.
Number 4, set up automatic investing. Open appropriate accounts like an IRA, 401k, or brokerage, and automate regular investments into a low-cost total stock market index fund like VTSAX or VTI. Number 5, develop iron discipline. Commit to staying the course. Ignore market fluctuations, economic news, and financial pundits. Trust the simple, long-term process. I hope this summary of J.L. Collins' The Simple Path to Wealth demystifies investing and empowers you to take control of your financial future. If it resonated, please show some love by hitting like and subscribe to join our Brainy Bytes community for more clear, actionable summaries. Want to help fuel future content like this? You can support the channel by buying me a coffee through the link below. It helps me dedicate more time to finding and summarizing these impactful books for you all. And speaking of impactful ideas, what book on simple living, investing, or achieving financial independence should I explore next? Let me know your suggestions in the comments. Your input drives the channel. Thanks for watching.